Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Foreign currency bonds, a clear guide to global investment opportunities. Foreign currency bonds are catching more attention from investors looking to branch out and grow their money. These bonds let you put your funds into markets beyond your home country and gain access to global currencies. They also bring different risks and rewards that set them apart from local options. More people are getting curious about how these bonds can protect their portfolios and boost returns. In this guide, you'll learn what foreign currency bonds are, why they're gaining steam, and what you need to know before jumping in. Get ready for clear tips, real benefits, and smart ways to make the most of global bond investing. Understanding foreign currency bonds. Foreign currency bonds offer a straightforward way to tap into opportunities outside your home market. Unlike local bonds, these investments are issued in a currency that's not the official money of the country where you live. They can help add diversity, shield your portfolio from local market swings, and open doors to economies that may be on a different cycle than yours. Let's break down the basics so you know what makes them stand out. Definition and key features. Foreign currency bonds are a unique breed of fixed income investments. Here's what sets them apart. Currency denomination. These bonds are issued in a currency different from your country's home currency. For example, a U.S. investor can buy a bond denominated in euros, yen, or pounds. Issuers. Both governments and companies can issue foreign currency bonds. You'll see names like the World Bank, national treasuries, and big multinational firms in this space. Maturity. Just like regular bonds, they come with predefined maturities, anywhere from a few months to 30 years or more. Interest payments. You receive interest, the coupon, in the currency in which the bond was issued. Risk factor. Their biggest twist is currency risk. If the foreign money weakens against your own, returns can shrink, even if the bond itself performs well. Foreign currency bonds differ from domestic bonds simply by which currency backs them. With domestic bonds, both the issuer and currency are local. With foreign bonds, at least the money isn't. Types of foreign currency bonds. There are several flavors of foreign currency bonds. Here are the main categories most investors encounter. Euro bonds. Despite the name, these aren't just in euros. A euro bond is any bond issued in a currency that isn't native to the country where it's issued. For example, a dollar-denominated bond sold in the UK is a euro bond. Foreign bonds. These are issued by foreign entities in the local currency of the country where the bond is sold. Here are three well-known types. Yankee bonds. Issued by non-U.S. entities in the United States, denominated in U.S. dollars. Samurai bonds. Issued by non-Japanese companies in Japan, denominated in yen. Bulldog bonds. Issued by non-UK entities in the United Kingdom, denominated in British pounds. Dual currency bonds. These are a bit creative. The bond pays interest in one currency, but you get your principal back in another. This setup can give you exposure to two currencies at once. Each type comes with its own risks and benefits, letting you shape your investment to match your appetite for currency moves and interest income. How foreign currency bonds work. Understanding how these bonds get from an issuer's hands into your portfolio is key. Here's what the process usually looks like. Issuance. A government or company decides to raise funds by issuing a bond in a currency different from its home currency. This lets them reach a wider pool of investors or benefit from lower borrowing costs. Offering and pricing. These bonds are priced after considering currency value, interest rates, and credit strength of the issuer. Major banks or financial groups handle the sale and help set the terms. Trading. After they're sold, foreign currency bonds trade in international markets. You can buy or sell them much like other bonds, but prices may shift with both interest rates and changes in currency values. Settlement. The bond is settled, meaning ownership transfers, in the bond's currency. Interest and principal payments also come in that same currency, so exchange rates have a direct impact on your returns. Key things to keep in mind. You'll need access to international markets or brokers. Pay attention to local taxes or withholding rules. Monitor currency swings. They can boost or drain returns. Foreign currency bonds are a practical path to investing beyond borders. By knowing the basics, you can make smarter choices that fit your financial goals. Major benefits of investing in foreign currency bonds. Foreign currency bonds offer more than just a chance to invest outside your own borders. They unlock a set of benefits that appeal to investors looking for stability, new markets, and the possible upside of currency changes. By holding these bonds, you get direct exposure to different economies and potentially stronger returns than you might find at home. Let's break down 3 of the most valuable reasons people add these bonds to their portfolios. Currency diversification. Putting all your money in one currency is like stacking your chips on a single square in roulette. If that currency drops in value, your whole portfolio could take a hit. Investing in foreign currency bonds changes the game, reduces risk tied to your home economy. If your country faces tough times, having bonds in another currency can soften the blow. Taps into stable or growing foreign markets. Other economies might be on the upswing while yours stalls. Blends performance. Currency fluctuations sometimes move in opposite directions. Gains from one currency can help offset losses from another. Adding foreign currency bonds is a way to spread out risk. This approach can make your overall investments more stable, especially during swings in exchange rates or inflation. Potential for higher yields. When you put your money in foreign currency bonds, you unlock the chance to earn more than what your local market offers. Every country has its own interest rates, driven by supply, demand, and central bank policies. If your home rates are low, looking abroad could boost your returns. Access higher interest rates. Some countries pay more to borrow money, especially if they're trying to attract international investors. Take advantage of rising currencies. If the bond's currency gets stronger against yours, you pocket even more when you convert returns back home. Diverse income streams. Different interest payment schedules and rates can help smooth out your income if one market slows down. While chasing higher yields always means taking on more risk, the potential reward is real. This appeal draws both individual and institutional investors into international bond markets. Access to international issuers. Foreign currency bonds give you a front row seat to global players, far more than what you'll find in your home market alone. This access lets you invest in foreign governments, countries from Asia, Europe, South America, and beyond all issue bonds in popular global currencies. Reach top global companies. Multinational corporations often borrow in different currencies to raise funds for new projects or overseas expansion. Pick from a wider menu. You can find bonds from stable economies, emerging markets, or companies leading in technology, energy, and other key sectors. This variety lets you tailor your bond portfolio to your goals and risk tolerance. Whether you want safety, growth, or a mix, there's a wider world to choose from. By adding foreign currency bonds, you're not just buying debt, you're buying a stake in the future of other economies, industries, and ideas. That's a major upgrade from sticking only to local options. That wraps up part 1 on foreign currency bonds. If you found this helpful, don't forget to like, comment, and subscribe for more. Stay tuned for part 2, where we'll dive deeper into the risks, rewards, and strategies for investing in these bonds. See you soon! Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.